This video is an uncovered Japan company research report on CELSYS, ticker 3663. CELSYS is the Japanese company behind Clipped Studio Paint, a creative tool used for digital illustration, manga, and webtoons around the world. In the next few minutes, we'll look at what makes the business special, why the shares already carry a premium valuation, and the simple numbers that can tell us whether the story is still on track. This is educational content, not investment advice. First, a quick reality check. CELSYS is not a bargain bin stock. It trades at about 28 times forward earnings, and price to book is above 13 times. That sounds demanding, but the business has some rare qualities too. Return on equity is over 35%. Operating margins are above 30%, and subscription ARR reached 6.32 billion yen in June 2026. The big question is whether that quality can keep showing up in the numbers. Here is the product in plain English. Clipped Studio Paint is the digital canvas creators use to sketch, ink, color, and finish their work. It is popular with illustrators, manga artists, webtoon studios, and serious hobbyists. One product family accounts for roughly 86% of sales, so concentration is a genuine risk. But it also means the company is very focused. This is a single global software franchise, not a bundle of unrelated businesses. Now comes the part that makes the business more interesting. CELSYS is moving from one-time license sales toward subscriptions. Subscriptions are now about 52% of sales and are still growing more than 30% year on year. Instead of making a sale once and starting over, the company can build a larger base of recurring revenue each month. That is why ARR and churn deserve so much attention. This is where the operating leverage shows up. Over the last 5 years, revenue grew at roughly 8% a year, while operating profit grew at about 21%. The main reason is mix. Subscription revenue has high incremental margins, so each extra layer of recurring sales can add more to profit than to cost. It is a nice setup, as long as the subscription base keeps expanding. Profits on paper have bounced around because of restructuring, taxes, and other one-off items. So for CELSYS, it is more useful to watch operating profit, ARR, churn, and cash flow. The balance sheet has no debt, operating cash flow is solid, and management has tended to guide cautiously. That makes the monthly progress updates unusually helpful for following the story in real time. The price-to-book ratio looks enormous at first glance, but part of that is mechanical. CELSYS has bought back shares and canceled stock, which shrinks the equity base. That pushes return on equity up and book value down. So the 13 times PB is not automatically a warning sign. Still, it does tell us the market is leaving less room for a disappointing quarter. The defensibility is not just about lines of code. Artists build habits around brushes, shortcuts, files, and asset libraries. Switching tools means moving a whole workflow, not just downloading a new app. Around that, CELSYS has more than 13 million platform users, support in 11 languages, and a business that is mostly international. Partnerships with Wacom and Line Digital Frontier add helpful hardware and distribution links. The next big question is whether CELSYS can grow from a great drawing tool into a broader creator platform. If its planned 2027 platform launch works, it could earn more from community, assets, cloud services, and distribution. If it does not, the core app can still be a very good business. But then, the valuation will depend much more on keeping that single product moving forward. The market knows this is a quality business. On CELSYS's own history, a price-earnings ratio near 28 times is not wildly unusual. Against the broader software sector, though, it is expensive. Investors are already paying for subscription growth, high margins, and a little platform upside. From here, execution needs to keep matching the story. Think of the outlook as 3 possible paths. The bear case is slower subscriptions or weaker margins. The base case is continued ARR growth and steady profitability. The bull case adds a real second engine from platform monetization. The useful thing is that these paths are visible. Monthly ARR, registrations, churn, and margins can show us which direction CELSYS is heading before the annual results arrive. Here is the simple takeaway. CELSYS has a global, category-leading creative product, high margins, strong returns on equity, and a subscription engine that is becoming more important. At the same time, the shares are priced for quality, and the business is concentrated in one product family. The good news is that this is a trackable story. Watch ARR, churn, margins, and the platform launch. Those numbers will tell us whether the premium valuation is being earned. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security.